Well, to get started, my name is Jim Leach. I teach at the Woodrow Wilson School of Princeton University, and Princeton is hosting this event as a occasional seminar here in Washington, D.C. Our guest today is Paul Krugman. Many of you know Paul. By background, at the university, we consider Paul to have kind of a bi-oceanic personality. That is, he's recently been in Europe, where he's considered a royalist, hanging out with kings, the King of Sweden, who presented him the Nobel Prize, the King of Spain, who presented him something called the Asturias Award, which is the European equivalent of a Pulitzer. On this side of the Atlantic, he's considered more of a classic liberal economist. He's the recipient of the John Bates Clark Award, which is given for the top economist under 40 every several years. Paul is an author-editor of 23 books, several hundred articles on economics. He's a fellow of the Econometric Society, a research associate of the National Bureau of Economic Research, and a member of the Group of 30, which sounds a bit conspiratorial. But
Yes.
His most recent books are The Return of Depression Economics, a field pioneered by a fellow Iowan named Herbert Hoover, and The Conscience of a Liberal. And by happy coincidence, we have some books at the back of the room. If anyone wishes to purchase, they'd be welcome to, and Paul might stick around and sign afterwards. The way we have this structured is, rather than a formal address, I'll serve as moderator. We'll begin with 3 or 4 questions and then throw it open to the audience, and you're welcome to ask whatever you would like. We do have several microphones, and at least one I see, and it'd be helpful if you would go to the microphone, and we'll proceed in that fashion. Anyway, just to commence a conversation, I thought maybe we just ask Paul how he sees the genesis of the financial mess we're in, and what he sees as a way out. Paul.
Yeah.
Modest question.
Yeah. All right. So, I mean, I think that the story is the title of the show is Banks Gone Wild. I mean, essentially what we got was a financial system that spun out of control. We got banks and things like banks that did this enormous explosion of bad lending, of which the biggest manifestation was the housing bubble in the United States. But it's not just that. There were housing bubbles in Spain and Britain as well. There was a lot of what now looks like really ill-advised lending to a lot of emerging markets, especially in Eastern Europe. So there's this worldwide explosion of dubious lending, which was bound to come to grief and did. The consequences of that have been much worse than even pessimists thought. And I think the core of that is that we didn't understand that not enough people appreciated how much the financial system has changed over the past 25 years or so. That we thought that banks were fairly well protected, but we forgot that a bank doesn't have to be a big marble building with a row of tellers. A bank could be anything that borrows short and lends long, and or borrows liquid and lends illiquid. And there are lots of institutions like that. And the stuff that isn't formally banks was, at any rate, bigger than the stuff that was formally banks. And there was essentially no regulation, no guarantees, no policing on all of that. And so this whole thing, the shadow banking system has imploded globally. Housing bubble has imploded. In the United States, consumers, people thought that the rising value of their houses and their stock portfolios would provide for their retirement. They suddenly discovered that isn't true, and so they've started saving again. And all of these things. So it starts, the original epicenter of the thing is the collapse of the U.S. housing market, but now that's actually receded into the background. It's now falling dominoes all across the world, and it's ugly. How do we get out of it? Actually, the first thing is to prevent it from is to at least try to break this downward spiral. What's got me really scared now is the financial implosion has already happened, although it could get worse. Actually, I spend most every week or so I think to myself, well, things could be worse, and the next week they are worse. And but what I'm really worried about now is that we get into a situation of deflation, where prices, wages are falling, and that, if it happens, becomes a self-reinforcing process. Because as prices and wages fall, the burden of debt actually gets worse because you have a given dollar debt and you've got a falling dollar income, which is depressing. This is Irving Fisher from 1931, debt deflation. Plus, if people expect deflation, if you expect prices to fall, nobody wants to borrow, nobody wants to invest. And once you get into that kind of trap, it's very, very hard to get out again. So what you want to do, first of all, is try to break this fall, pull the nose of the thing up a little bit. And that's the one surefire way we have to prop up demand is for the government to provide that demand, to have a big spending program, which is what the stimulus package is about. Then you have to try to repair the financial system so that it functions again, which is actually, I think, harder, at least conceptually, and try to do that. And a little bit of prayer to the higher authority of your choice might be a good thing too. This is really bad. I mean, we don't know. We don't have any precedents about well-designed, planned recoveries from this kind of trap. The Great Depression was ended by a very large public works program known as World War II, but it wasn't a deliberate policy. The Japanese lost decades. When it ended, such as it was largely an export boom, which was possible because the rest of the world, especially China, was booming and provided a market for Japanese exports. That's not going to happen now because we're all in this slump together. So we don't have a role model to follow, and so this is really scary stuff.
On the spending side, there's pretty good consensus that we ought to have some sort of stimulus package. There's not perfect consensus on the size and the composition. Would you care to comment on either of those?
Both, actually. Okay. Size. The Obama package is too small. The efforts to shrink it are the wrong direction. How do we know that? One way to look at it, actually, the Obama estimates are that that this thing would add 3.5 million jobs, compared with what would otherwise happen by the end of next year. That's and then it fades out. I just looked at this morning. We had an employment report this morning. It was absolutely terrible. Unemployment rate shot up to 7.6, 598,000 jobs, I think, lost. It just really, really bad. We've at since the official start of the recession in December of 2007, 4.1 million people have been added to the unemployment rolls. And this thing is still heading steeply downwards. So even if the Obama package works as advertised, it actually is only a partial offset to what's happening. If you believe their own estimates, it's maybe closing about a third of the gap that we're facing. Now, I understand it's not easy. Particularly, it's not easy to spend. Believe it or not, it's not easy to spend a really large amount of money quickly. And even if you say, well, look, this thing is going to last for several years, it's still hard to get a spending program the size that we want. But it's if you just do it by the numbers, it's really too small. The typical estimate is we're facing something like a shortfall in private sector spending over the next 2 years of around $2.5 trillion. And we're, at the moment, looking at a sort of $900 billion plan, which is, it's addressing the gap. Sorry, folks. There we go. So it's not a solution. It's a, but it's a amelioration. it's not really an answer. Composition. You wouldn't understand this very well from the debate that was going on in the Senate these last few days, or even worse, the House, right? But the problem is the clear and present danger is not enough spending in the economy. So what you want is programs that will increase spending. If the government spends money, then the money is spent. So if you hire people to repair a bridge, you have directly created the jobs repairing the bridge, and then you hopefully have secondary effects as those people spend, as the workers spend their extra money, you get some multiplier effect. If you do a tax cut, there's no guarantee that all of the tax cut will be spent. And in fact, particularly if it's a temporary tax cut, and people understand that, they're likely to sit on a lot of the money, which is what happened with the stimulus package early 2008. Most of it went to savings rather than increasing spending. So bang for buck is much, much higher if the government spends the money. So that in itself would say that the package ought to be all spending. Now the reason for that we're not doing that, aside from political bargaining, is there is an issue of speed. And if we say, okay, we're going to stimulate the economy by doing another big dig in Boston, well, we know that actually took like 15 years, right? That's too late to help in the current. So it's got to be stuff that can be started reasonably quickly, and there's a limit on how much of that you can do. So one piece of the program is infrastructure spending and such like, which is sort of the ideal thing. We also need our infrastructure needs repair and expansion, so that's good. But it is limited by the lack of lots of projects that you can do fairly quickly. Second piece, which is unfortunately what they're trying to cut in the Senate now, is aid to state and local governments, and that happens to be good because state and local governments, which operate under balanced budget requirements, are being forced to slash spending right now, and one very quick way to increase spending relative to what it would otherwise be is to prevent spending cuts. So if you can give aid to state and local governments, that helps. And then there's a role for some tax cuts in there because although they may be not the most effective, they are probably the quickest thing you can do aside from aid to state and local government. So there's some of that. But for my taste, the balance is still too much. It's too many tax cuts, not enough spending. There's no coherent economic theory under which even more tax cuts would be a good thing to do.
Coming to what's in the tax cut versus, and then what is better and what is less good, and then on the spending side, you're an expert on the Depression. Is there a potential room here for a WPA at this time?
Okay, so tax cuts. About half the tax cuts in this thing are the Obama making work pay, which was a campaign promise, which is essentially giving people a tax credit on their income tax, a refundable tax credit against part of payroll taxes. And it is a more or less clear-cut redistributionist thing. It's designed to help lower and middle income workers. Not my favorite policy, but it is likely to put a fair bit of the tax. The people receiving this will be more likely to actually spend the extra money than say if you just cut top marginal rate. And it is also, since it's supposed to be a permanent policy, it might have more effect on demand because people would. And there's also this idea, I don't know exactly where they are, that it instead of being a check that you receive in the mail, it would actually be literally a cut in your tax bill. And there are some reasons based on behavioral economics to think that that's more likely to change people's spending than a check received in the mail. People receive something that looks like a bonus, they're likely to salt it away. If it just looks like your paycheck is bigger, They're more likely to spend. So that's, I'm not wild about that. I give it sort of a B or a B minus, but that part's okay. Then there are a bunch of business tax cuts, which are mostly really quite bad. The extended carryback, I think I've got that right, where businesses can count their current losses, because everybody's making losses now, against past profits to reduce their tax burden. However much you might say that that's a lot of business would like that, but that gives no incentive to actually spend that money on investment. So you've got a business that's losing money right now, and they're also saying, we're not using the capacity we have. Why should we add to capacity? And then they get a tax break, which improves their bottom line. They're still not going to add any capacity. So there's some fairly large chunks of the tax thing that are very close to zero bang for the buck, and I think they're there for political reasons. They're there because not just Republicans, a lot of everybody listens to their constituency, not their constituency, their contributors, so my take on it was that about 15% of the stimulus bill is really pretty ineffective stuff. Which I have to say is, I'm kind of grading this thing on a curve. I think that's not so bad, right? It's given the difficulty of getting something like this together, that's not too bad. In my ideal universe, we would have it would consist entirely of aid to lower level governments plus really terrific infrastructure projects. As it is, the bill that came out of the House was not bad. It was an A-/B+ bill. The bill that may come out of the Senate negotiations right now will be substantially worse because it will have added more bad business tax cuts, and because they're slashing, it looks like they're going to cut some of the aid to state and local governments, which is one of the more important parts of the bill.
But no appetite for WPA.
Oh, WPA. We want to do WPA type stuff. We certainly want to do a lot of infrastructure, and whether you want to structure it. In the WPA, you have 5 million people who are working directly for the government. It's not clear that makes sense right now. I'm not ideological on that. I think that probably modern infrastructure projects require a little bit more specialized expertise, specialized equipment. But if a way can be found to do it, fine. But the WPA was under really extreme circumstances. Unemployment was 25%, and so the government was hiring a lot of people at quite low wages and putting them to work. And it was also somewhat a simpler time. There was more stuff that we talk about shovel-ready projects, but in the 30s there were still a fair number of things that actually just did require shovels, and that's less true now. But I'm open if somebody can come up with reasonable stuff of that kind. But it doesn't have to be. Fix those bridges. Build that second rail tunnel under the Hudson. That's the infrastructure project I want. And it doesn't much matter whether it's direct government employees or whether it's done through private contractors.
How would you structure a bank that's insolvent?
Yeah. That's, by the way, I came out swinging this morning in the Times for the pass this damn stimulus proposal, but we're hearing that that Geithner, the Treasury Secretary, is going to announce the bank proposal on Monday, and I'm expecting to be able to balance my big Obama support column with a really hostile column on, unless the proposal is a lot better than what we're hearing right now. No, I mean, actually, story. I had about 2 weeks back, I wrote a column about the bank issues, and I wrote it in terms of a hypothetical bank with $2 trillion in assets named Gotham Group. I got a call from the Times legal department. I thought, oh no, Citigroup is coming after me. But it wasn't. It was the Gotham Bank of New York, which thought that I had. Anyway. But look, let's think about Citigroup or Bank of America. Now, I don't know this for sure, but we look, and the two have got a combined market value of not much over $50 billion. We've got something like almost $4 trillion of assets, but the market is valuing them at something like $50 billion. And that value almost certainly consists entirely of expectations or hopes that stockholders are going to get a windfall from government bailout. It's the Geithner put, I've been calling it. So these banks are certainly very close to not being solvent. Maybe there's some, if they were given time, they could work it out. Very close. So what do? We have to keep these, and we have to keep the banking system operating. We have to keep these things functioning. People talk about, well, we're going to take the bad assets off their balance sheets, and that will clean things up. I think that's a bad metaphor. People, whoever came up with toxic waste for this stuff, although it was it's a punchy name, it creates this belief that I've actually seen people write this, that the bad assets infect the good assets, and therefore, that's not what actually happens. Because if a troubled bank wants to get bad assets off its balance sheet, it can do that. It can just write them down to zero and say they're no longer on our balance sheet. The problem is that it wants to get a high enough price to make the bank solvent. And the fact of the matter is they try and sell them, they don't get a high enough price to make the bank solvent. So the question is what makes the bank solvent? And all of the stuff about getting bad assets off the balance sheet is really just a complicated way of somewhat disguising what's going on. So the proposals we've heard that we're going to have a government agency buy up these bad assets runs in just head on to the problem. What do you pay for them? If you pay what the banks can currently sell them for, that's going to leave the banks underwater. If you pay much more than that, then probably you're making a huge transfer from taxpayers to stockholders unrequited. So, what we have, the actual lesson we have from previous experiences is that if you have a bank, there's a third thing you can do, which is you can inject capital into banks. You can give them a bunch of money and take shares in return. And the problem, or it's seen as a problem, is if you do that right now, since the stock is worth so little, say that, reasonable guess, say that Citigroup plus Bank of America need $300 billion more capital. Have the taxpayer pay that? Well, their current market value is only about $50 billion. So for all practical purposes, if you take shares in return, we've turned them into we've nationalized them. What I would say is, okay, let's do that. And then if you want to deal with the bad assets, you transfer the bad assets over to a government holding agency. You also have the government pay off a bunch of their debt, and then you can resell them to the private sector. So you've got a going concern, and then we try to dispose of the bad assets as best as we can, which is what happened after the S&L crisis of the 80s. But policy is just being tied into knots because people are deathly afraid of the idea that of having even temporary public ownership of major banks. And it's I think that's a prejudice that is getting really much in the way of policy. The one story said that the officials believe that government officials make bad bank managers, which is probably true, but compared to what? Compared to the guys who lost a couple of $1 trillion in the last few years.
I'm going to make this the last question. We're going to throw it open. So you guys that will have questions, you can start to line up if you want. But all of the attention has been to the big banks. Interestingly, in America, the vast majority of jobs are created by small business, and almost no attention is going to the community banks. And so the question is, how do we energize small business, and how do we deal with the community banking system?
I mean, I don't actually know what to do. By and large, the smaller banks are in better shape.
Much.
In fact, I was stunned. I was looking for a little bit of data on market cap, and you look at the highest market capitalization banks in America, and the really big ones are incredibly far down that list right now. And I think the biggest out there is a bank I'd never heard of, which turns out to be mostly operating in Puerto Rico. And apparently just sort of never got into this stuff, never got into the complicated securities, and so it's a nice profitable bank. It's worth more than $100 billion on the market, so it's worth it's certainly worth more than Citi and Bank of America combined. I think it's worth almost as much as Citi, Bank of America, J.P. Morgan, and Wells Fargo, which are the big four combined. And this is banks you've never heard of in Puerto Rico. There is a question: how much can we, in fact, try to beef up these banks and have them take on some of the role of? I'm not sure quite how that's done. I actually was at a meeting a couple of months ago with Governor Corzine and people. They were batting around stuff like that. So it's certainly a place to go. And I don't know that we need a special small business policy, but you want to have this. Small businesses are probably on the whole the worst hit by the credit crunch, so that if we can resolve that, it helps. But these big banks, nobody loves them. There's a strong temptation to say, let's just let them reap the consequences. Let's just let them fail. But we tried that with Lehman a few months ago, and within 48 hours we were staring at the end of the world. So we've got to keep them operating. It doesn't mean the stockholders deserve anything. It doesn't mean the executives deserve anything. We have to at least keep them functioning.
Let me throw it open to questions. Yes, do you want to use the microphone? I think it'd be...
Okay.
Patty
Can we pass it? Or?
Maybe Patty.
Oh, yeah, that's better if we can. Okay.
All right. Good. Okay. All right. Good. We'll begin with the young man here then, and then we'll go to you, sir. Do you want to give us your name, too?
Why didn't I just show it's working?
Okay.
Yeah, I had a question about investment banking bonuses. I just wondered, what did you think? Do you think they played a significant role in getting us into this mess? And also, do you think they're going to survive? Because there are lots of moves afoot to limit them, to make sure that bonuses are vested for like 10 years or something like that.
Yeah. The compensation structure in the financial industry created enormous perverse incentives because you basically get you get a big bonus from recording profits in any one year, and then if there's a later year in which those profits turn out to have been an illusion, you don't give it back. Actually, Andy Lowe, finance professor at MIT, had a paper. He focused on hedge funds, but it actually applies to the industry as a whole. This was back in 2001. It was a perfect preview. And he described a hypothetical hedge fund, which he called Capital Decimation Partners, which did nothing except leverage itself up, take huge risks. And he just showed, based on on statistical analysis of typical returns, it would collapse almost surely within a decade. But before it collapsed, it would make enormous wealth for the people running it. And the whole industry was pretty much structured that way. Now you have to wonder why didn't anybody blow the whistle on this before? And we'd like to hope that compensation packages will be structured differently so that it doesn't work that way. And of course, right now, the limits on executive compensation and bonuses on firms that are basically, on financial firms that are basically being kept alive by taxpayer support is perfectly reasonable. I mean, somebody said this is not original, but said that all of the major money center banks are now, as far as in a fundamental sense, they're all now federal agencies. They're all surviving by the good grace of the taxpayer. And there's no reason why the people running them should not be paid like high-level federal officials rather than like masters of the universe, which they no longer are.
Sir.
Professor Krugman, I'd like you to consider our present situation as an opportunity. For a number of years, our public investment has been shortchanged. Not only bridges and railroads, but public parks, national parks. Also, we're in a situation where we depend on imported energy, and we spend so much money on it that it causes unpleasant effects in the producers of that energy, which then redound against our interests. And we've entered this crisis with an enormous public debt, and it's ballooning. But that may not be bad, because we have a lot of resources that if we could employ them by public debt, it's not costing anything because they're not doing anything. So it seems to me what we need to do is put a substantial energy tax on petroleum, and I would say on all carbon, and then at the same time start a program to help people develop clean energy. And I think that would put our people to work. And I'd just like your thoughts.
Okay. I mean, I'm very much for carbon tax as quickly as it can be done. Politically, it's probably going to take some work. And unfortunately, it's really hard to get that through in the middle of a slumping economy. So as a citizen of the world, I'd say do it now. If I was advising Obama politically, I'd say wait until we've got wait until the economy is roaring back and you can declare morning in America and say now it's time to deal with our environmental and energy dependence issues. Public investment in that area is something badly needed, but it is the kind of, we don't have shovel-ready projects on clean energy. We don't have, there are some probably more than I'm aware of, but it's not like there's you're not going to be able to find several $100 billion a year of stuff that is likely to arrive in the next 2.5 years on that. So it's worth doing, but it needs to be understood. And let me just say about the public investment thing, more broadly, yes, we've underinvested. I thought it was a shocking moment when Republicans denouncing this bill started ridiculing $200 million fixing up the National Mall. I mean, this is a public space. It's America's public space. What's happened to our pride? This is the capital of the world's greatest nation. Aren't we supposed to maintain it properly? There's all this stuff. Small numbers funding for the arts get trashed as a total waste of public money. Didn't think of the Emperor Augustus. Why aren't we supposed to be doing some support for culture again? But of course, much more than that, we have a creaking infrastructure. Our big years of public investment in this country were back when that socialist Dwight Eisenhower was running the country, and we really have not maintained it since. And we got to do this. There are little things. People in America don't realize that we're. It's not just what we think of as characteristically European stuff like high-speed rail that we don't have. We don't have. We're falling behind on things like broadband speed. So there's a tremendous amount of stuff that we ought to be doing. And yes, a severe recession where public investment is not only good for the long-term future, but also helps prop up the economy right now, is an opportunity.
We have several people over here, Patty, and then I'll come back over here, but I want to, we've been ignoring this side of it.
Roger Kirk. My question is that there's talk about, well, the balance between putting some money in this stimulus package and things that we good in the long run,
Right.
like computerizing medical records and things like that. Is that a good idea? Is this the only moment you can get some of those things going if you think they're good, or should that be dropped?
I think that is a real tension. There is a real balance. How much do you want to focus it on stuff that basically this is the clear and present danger is the depressed economy, and so you have to. The central focus does have to be on stuff that will support the economy during what's probably at least a 3-year period of being depressed. So projects that are where the bulk of the spending is going to come after 3 years are not something that you can justify as part of this. We certainly need to do these things. And there's a fair bit of overlap. So there are a fair number of things where we can support the economy and also do long-term investment. But I think you do need to keep the focus. Now, as it happens, computerizing medical records is one of those awesomely effective things, if you can do it, that we are incredibly far behind on. It's one of those things people don't believe. They assume we must have the highest tech medical system in the world, and in fact we don't by a long shot. The two great leaders in electronic medical records and making optimal use of that are the Veterans Health Administration and the British National Health Service, and we're way behind. So that's something we ought to do. I'm not sure. I don't know what the profile is in terms of how much of that spending can come on quickly.
My name is Len Kennedy. 2 data points and a question. On the day the bailout bill passed, Bill Gross was asked if it didn't work, what he thought it would take to solve the problem. And at that time, he said $1 to $1.5 trillion. Yesterday on Bloomberg, he thought it would be $5 to $7 trillion to solve the whole problem. And I'd be interested in your view on that. And then a question: if it in fact is the case, and I think it probably is, that the banks are insolvent and will require massive capital of one sort or another, why is it that the bondholders oughtn't to be equitized and share the risk and participate that way? After all, they're not Freddie, they don't have any implicit guarantee of the like or anything of that sort.
Yeah. In defense of Bill Gross, although to some extent he is talking his book, so we know that. Between the original announcement of the TARP and now things have, we've had a lot of news. Things are worse than we imagined. Among other things, it's not just that the U.S. weakness has turned out to be deeper than we thought, but also that the global spread of this has been much greater, which in turn feeds back on us. So that the fact that that Japan appears to be in free fall, the fact that China appears to be in a severe slump, the spread of the financial crisis, the really horrific stuff going on in Eastern Europe, all of that bears on it. That makes it's not unreasonable to have a bigger number about what it takes now than what we said before, and it shows. I mean, if you look at I don't know where Bill Gross is getting his number, but I do read the Goldman Sachs reports, and they one of the themes they've been putting out lately is that the troubled assets now is a much wider set than just the mortgage-backed securities. It's now credit card debt-backed securities. It's commercial real estate, and so what originally was $1 trillion or so of stuff that was problematic is now $3 $3 to $5 trillion worth of stuff that's problematic, and so it's bad. Bondholders, yeah, the thing I think is that you'd have to be really careful if we're going to try and impose a haircut on creditors of financial institutions. You want to think of these things as being de facto banks. In doing de facto banking, even where they aren't formally doing banking. So any short-term credit they have is playing a role very much like bank deposits in a conventional banking crisis. And when you have, in that kind of crisis, you do not want to make the depositors lose money because of the panic that creates. And how much longer-term debt there is and how much you can really, in any practical terms, impose a haircut on those bondholders, I don't know. But I believe it's a fairly small part of the thing. And look, I mean, at this point, I'm still in a rhetorical battle trying to prevent a windfall, squandering a lot of money on a windfall to stockholders. Trying to find another group of people that we need to punish is probably beyond us here.
I have this gentleman first, and then I'll come to the back, but go ahead.
Larry Lewin,
Yeah. Excuse me.
Two-part question. First of all, it's always seemed to me curious that with all the smart people he's got around him, both inside the White House and outside, that the president decided to leave it up to Nancy Pelosi to formulate this bill. Maybe Congressman Leach would like to comment on that as well. And my second question is, we haven't heard, aside from computerized medical records, we haven't heard very much about spending on health care other than S-chip, and maybe the states would use the relief to avoid cutbacks in Medicaid. Would you comment on whether or not you think that spending on health care, either through a major expansion of coverage, would be recovery kind?
Do you want to?
No, go ahead.
Okay, so let me say, by the way, I don't have a big problem with Nancy Pelosi doing a lot of the stuff. I actually think she's pretty good. But but it is true. I am a little put a question mark on this. We've had this economic team. They've had since early November. It's hard to see a whole lot of stuff. They clearly are still trying to make up a bank rescue plan, which I've been told they've been working on nonstop, and there's no evidence of the output of that process. The stimulus bill was they pretty much came up with a number and then said to congressional staff, you create this. And again, things do not seem as organized as I was expecting. We can speculate about what might be going on there, but I probably shouldn't. It's just to say I was hoping for more decisiveness, more cohesiveness than we've seen so far. Now, it's a running joke among people I correspond with, saying, oh no, 18 days into the administration, he's failed already. This is crazy. But the start was not as vigorous on economic policy as I'd hoped. It really wasn't until yesterday that Obama started giving the kinds of speeches on economic policy I was hoping he would give. So, but yesterday was great. So let's see how it goes from here. Healthcare, yes, I actually should have said. If we could get going on the kind of healthcare plan that Obama promised during the campaign, which includes as a key component fairly large subsidies to help lower-income people buy health insurance, though that has to be coupled with other stuff. That's money that's highly likely to be spent. Since it's part of a permanent program, people would regard it as a benefit that they can count on, and it would be the costing of a Obama-Clinton style healthcare plan. Finesse the differences between them. That sort of plan that builds on the existing system, but adds subsidies, adds regulation, adds a public alternative, is supposed to be about $100 billion a year in federal outlays, and that would be a pretty good stimulus, that $100 billion. So if they're planning to do this anyway, then why not have that coming forward to help the economy? Now, of course, the problem is that there are some questions about whether they really are planning to do it, and some questions about whether fundamental health care reform is really going to make it through Congress. But I would very much... There's a good guess that they will be coming back. There will be a second installment on the stimulus plan. I sure hope that universal health care is part of that.
One thing real quickly, though, I mean, there's a constitutional obviousness that's at issue here, and that is the Constitution says the House of Representatives begin spending the bills, but the second is you have a transition. And it's true that this was the most successfully managed probably in modern times. On the other hand, that's really just putting on people at the top. And to put people below that write bills, et cetera, before one is in office is really difficult.
Yeah.
And so I think it was kind of natural that the Congress might have led more than the public might have wanted or Paul might have wanted. And I think as the months go on, you're going to see a little more executive branch leadership in terms of the nuts and bolts than the first week or two.
Although I understand that in fact, and it's true also the congressional staff has the expertise and the detailed stuff but it's also true that it's not just, this is not just a personal transition. There is a if you like, there's a progressive infrastructure. Obama could have gotten the guys at the Center for American Progress, and the guys at the Center on Budget and Policy Priorities to do a lot of work for him. I'm sure everyone would have been happy to do that. So this was a little underdone, but that's water under the bridge. Now the question is, what do they do as they move forward here?
Let me go way to the back because we've ignored this group. Yes, with the beard, young man. Yes.
Thanks for supporting the back and beards as well.
Yeah, I just did an event at the Times with Andy Rosenthal, and he said, isn't it great to be having a couple of tall, clean-shaven guys? Anyway, we both kind of look like me. Anyway.
And also, I used to sit in the back in your class, Professor Krugman, too. So, I had a question. I think most of the debate on the stimulus is about maximizing the bang for the buck, and it seems to me like we should be more interested in knowing the bang and then figuring out the buck. So I was wondering, in your opinion, if we had the right bill, what is the minimum buck for the right amount of bang?
Okay.
And then also, what is the economic argument for an all tax cut stimulus, and why, in your opinion, is that bankrupt?
Okay. I mean, the bang. I mean, basically, there's kind of a minimum $2 trillion shortfall in demand over 2 years. A very effective bill would have a multiplier of 1.5, 1.6. And at least when I do my arcane little modeling exercises, it says that the stimulus package should be big enough to actually close the gap completely. Because basically resources are very cheap as long as the economy is underemployed. You really want to do the maximum. Now, there is a concern about debt, but it really should, under a wide range of circumstances, really should do the whole thing. And what that says is we really should be looking at a package which was in the, for 2 years, which was in the $1.3, $1.4 trillion range. That's where I think we ought to be. Now, I understand it's actually technically hard to do. It's hard to come up with enough stuff to have that big a package, but that's where the logic leads. There is a concern. Now, I think the bang for buck thing does matter because we are running up debt. And although the United States has substantial running room, we have a lot less debt than some European countries as a share of GDP, so we actually have substantial running room. We don't have unlimited running room. I think we can do. We can run a cumulative $4 trillion of deficits over the next few years, If you make it $6 trillion, I start to get nervous. So the bang for buck does matter. And actually the difference in bang for buck is bigger than most of the numbers you see. Because if you do a spending bill that adds $1.50 of GDP for every dollar that you spend, a good part of that $1.50 of GDP comes back in the form of higher tax revenues. So a really effective bill costs much less than the headline number. An ineffective bill, if you get 50 cents of GDP for every dollar in the bill, then you don't get very much tax revenue back. And so the gap between them is much wider than you'd think. This bill that we're talking, the House bill at a headline cost of, I think, $820 billion. Realistically, it was probably going to add less than $500 billion to national debt because of the expansionary effect. As you start to degrade it, from my point of view, make it less effective stuff, that the numbers get substantially worse. A $600 billion all tax cut bill might well end up adding more to national debt than an $800 billion spending bill. Would add more to national debt while actually doing less for the economy. Now, the all tax cut, there has not been any coherent argument for why tax cuts should be preferred. There's the sort of generic argument that, well, people can spend their own money better than the government can, which I think is that's actually a really bad argument, because we know that's not true always, right? We don't say to people, okay, we don't need a police department here. Why don't you spend your own money on personal security? We know that there are things the government needs to do, and the real question is, at the margin, is an additional dollar of public spending or private spending better? And that's an arguable point, but what we know for sure is that an additional dollar of public spending is going to do more for the economy than an additional dollar of tax cuts. So it's really very hard on any kind of model, I understand, to make the case for emphasizing tax cuts in this bill. If you look at the arguments actually made, and then there's the kind of just sort of, there's been some playing games with the numbers, misrepresenting some of the past research of Christina Romer, the chairman of the Council of Economic Advisors, and a whole lot of stuff. But you actually, I don't recommend doing this, but read through the transcript of Republican arguments in this debate on the floor of the Senate, and you will not find any coherent thing. You'll find basically throwing out every possible argument against government spending in the hope that something will stick. I don't think it has anything to do with any coherent theory. It's just a distaste. People are, if you're a conservative, you are actually quite afraid that we're going to have a large government spending program and that it will work. This would be a real disaster for your whole movement. So I think that you need to think of that as sort of the background motivation.
Why don't we go to the lady way in the back so we get both sides, then I'll come back to you.
Okay, thank you. My name is Christine Pensich. My question actually builds on the prior one. I am trying to think a little bit about sort of the long-run consequences of a current stimulus package. Obviously, the current package is going to add to government debt, as you were just discussing. That could then call for raising taxes in the future, which will tamp down living standards. So how much of a concern is it, would you say, and how plausible is it that the current package could be designed badly enough that the long-run costs would outweigh the current stimulus effect?
Right. Yeah, so that's actually, there is a coherent argument that says that no stimulus is better. I don't think there's a coherent argument that says that tax cuts are better than spending. There is a coherent argument that says no stimulus is better, and it depends on, sound economistic here, it depends on the parameters. How wasteful do you think the program is going to be? How big do you think the multiplier is going to be on spending? How much of a problem is how much long-term disincentive effect does a higher tax rate at some future date to service that debt impose? Now, I believe that you actually have to work very hard. You have to make some pretty unreasonable guesses about those numbers in order to make stimulus a bad idea right now. But I can respect somebody who disagrees with me about those numbers. My bottom line on this is the simple, is the extremely scary nature of the crisis. That the risks that this turns into a really self-reinforcing downward spiral, that we get into a deflationary trap and we're in it for a very long period, is, for me, trumps the long-term budget concerns. And I think I can make a pretty plausible numerical argument about that as well. But if you don't buy that analysis, you can, I understand the counter-argument. I guess this has been batted back and forth, but and people on my side of this do say that argument that says that, look, the burden is just too high, are at least, it's a respectable argument. I just don't think it's right on the numbers.
When we go here, the gentleman right there.
Hi, my name's Neil Wasserman. I'm an avid reader of your column, as I'm sure almost everyone in this room. I wanted to ask a question that may connect global warming challenges with the economic crisis, and that is, what is the cognitive time frame that we think about these problems in terms of? And it seems that we've got into the crisis by transforming long-term debt obligations into short-term securitized instruments that basically incentivize short-term actions as opposed to long-term stability, or that at least was one factor. But the time frame cognitively that we think about recessions is usually 18 months, 2 years. But the actual risk that you're highlighting is an event which hasn't been all that infrequent of deflationary spirals that lasted, say, 15 years, 20 years. And that's occurred several times in our history, and in recent case in Japan. And the question is, how do you transform from a cognitive perspective the time frame that we think in terms of the effects of decision making that we're making, that actions that we're taking now on the long-term future?
I'm not sure I can. Well, let me just say the first thing about recessions. We have a real problem now with there's a dissonance between the way recessions are dated and our actual experience. And basically, there is no formal definition of recession in the United States, but the Business Cycle Dating Committee of the National Bureau of Economic Research is, by long-standing tradition, defines a recession as a period when everything is going down, more or less. And as soon as some important things start going up, the recession is over. But the last two recessions have, although industrial production and GDP started rising after 8 months, employment did not. And so we look and you say, well, the 2001 recession was brief and mild, it was over in 8 months. The fact of the matter is the unemployment rate kept rising for well over 2 years. So even when people say, well, it was a brief recession, it wasn't as far as most people were concerned. It was actually an extended period of job problems. And there's every reason to believe that we're going to see a magnified version of that this time. So part of our notion is we have prior to 1990, recessions tended to be like that. When you came back quickly. But since then, for reasons that are, I think, pretty fundamental, change in the nature of the recessions, they drag on for a long time. And this one could very easily turn into a lost decade, Japanese style. So that is really important in all of this discussion. Cognitive frame. I mean, I'm not sure it's so much a cognitive frame. I think it is that we have structured a lot of our system. It goes back to the early on question about compensation schemes. We pay our financial executives based on very short-term results. We have a political, the literature on what determines elections says that they're mostly determined by what's happening to the economy in the 6 months prior to the election. That was true of this last election too. Probably the most the key person in the Obama campaign, the person who deserves most credit for that victory, is Dick Fuld of Lehman Brothers. Without the Lehman crash, this might have been a very close election. So that it is hard. I don't know, but it is true. Why did previous generations manage to do so much public policy with a long time frame? Why can't we do more of that now?
I apologize with all these hands, but I've been told one more question. Why don't we make it two more? We'll do one side and one the other. This gentleman with the light-colored hair, please.
Thank you. Dave McNally, you mentioned at the outset you raised the specter of deflation, falling prices and wages. What about inflation? If the government basically prints and spends $1, $2, $3, or $4 trillion over the next couple of years?
Okay. I have this professorial thing. I want to say good question. Basically, inflation doesn't happen. If you print money and it just sits there, it doesn't cause inflation. Japan printed lots and lots of money during the 90s, and it just sat there. I mean, according to a Japanese economist I know pretty well, the only consumer good that was selling well was safes. And so there's no imminent threat of inflation from any of this stuff. What you worry about, or what one could worry about, is if the economy gets back on a solid recovery, if and when, will the Fed be able to call all that stuff back? And my answer to that is yes. It's not going to be hard. In fact, they're itching to do it. They would, at the first sign that they can, they're going to shrink that balance sheet and pull the stuff back in. But I can understand that people might have some concern. We are not, but really serious inflation tends to come either when you have people are excessively optimistic about how low you can drive the unemployment rate, which is more or less what happened in the 70s, or more traditionally when you have governments that really rely on the printing press to pay their bills. We are not that kind of government, and I don't think we're going to be that kind of government for, I don't think we're heading that way. So I don't worry about it too much, but, and right now to be worrying about inflation, it's an old line from the 1930s. So people, believe it or not, lots of people were worried about inflation as the Great Depression was in full plunge because they looked at banks, central banks printing money, and the line was saying, you're crying fire, fire in Noah's flood. At this point, I just don't think that's on top of the agenda.
Do one more on this side.
Yeah, I'm in favor of giving the big three a breathing space. There's a little bit, okay, the companies are in trouble. Why can't we just do Chapter 11, which allows a company to remain in existence but grants debt forgiveness? And the answer is it doesn't work right now. First of all, DIP financing is not available because of the state of the credit markets. Secondly, automobiles are durable goods, and therefore consumers won't buy a durable good from a company they think may be out of business in a few months. It's not like the airlines, basically. So if you're going to want to keep the companies in existence, you have to do some kind of bridge financing support. That's the. Do we want the companies in existence? I think we want to give them a chance. There's at least a reasonable possibility that they might be able to survive in some shrunken form if they can get through the current crisis. They also might not, but you don't want credit crunch to push them over the edge when they might be able to survive, because that is at least 1 million, possibly a lot more jobs that would be lost right at a really bad time. So should we get tough on the auto industry? Yes, but not right now. I mean, on a lot of things, I've been quoting St. Augustine lately. You know, "Oh Lord, make me chase the continent, but not yet." And so on the auto thing, this is one of the things where it's not like we don't have to have an auto industry in the way we have. We don't have to have a traditional American-owned auto industry in the way we have to maintain a financial system. But there's a reasonable case for sort of keeping them afloat through the next year or two, so that we preserve the option value of possibly that industry surviving.
Well, let me thank you. I know this is, Paul has a schedule, but he's willing to stay and sign some books. You're free to ask him questions then. But let me thank you, Paul. These books are, I don't know if you notice, the doors are locked. If you buy a book, they'll open it. But anyway, thank you all very much, and thank you, Paul.
Thanks.